The last 40 years has been a great time to be an investor. Most asset classes, whether equities or bonds, and wherever they are in the world, have tended to go up and go up a lot. In some ways, in retrospect, it's been quite a simple time. So over the period, we've had consistently lower and lower inflation, lower and lower interest rates, and really helpful supporting factors like globalisation of capital and goods, and great population demographics in the East and the West. Now, we've got emerging inflationary problems now, shortage of commodities, changing demographics, and of course, global conflict. And this is putting much more stress on the system. Now, with inflation coming back, the world needs to decide whether it prioritises inflation reduction or prioritises growth. Now, depending on which way it chooses to go, different assets are going to do well. So what does inflation reduction mean in practice? Well, the problem that we have from an inflation standpoint is supply's been reduced. So we've seen deglobalisation, so shrinking markets, including the conflict potentially with China and Russia. We've got rolling over demographics of population, an aging population, so a shrinking workforce. And we've got quite a lot of shortages in commodities. And there isn't much we can do about any of those in the short term. But demand is still high because there's a lot of money in the economy. So if you want to bring them in line, you've got to reduce demand. And that means probably pushing policy to the extent where you get quite significant recessions globally. If we successfully execute an inflation targeting strategy in the world, we will have quite significant effects on the real economy and financial markets. So if you think about the economy, well, we're going to have much higher unemployment, much lower wage growth, but at the same time, we're probably going to have more income inequality and wealth inequality. Very much the trends of the last few years, perhaps accelerated. If you looked at the high streets, if you came back in 18 months and wanted to know whether this had happened, you'd probably see a lot of boarded up shops. So I think it would have quite a significant impact. And politically, it's probably going to be very challenging to do this because of the anger and angst that many people already feel that would be increased by this action. However, if the world is able to do it successfully, the impact on portfolios could be quite positive in the short term. So as inflation was reduced and tackled, you'd see bonds actually rise in price quite a lot. The yields go down, the price rise. So I think for bond investors, it would be pretty good and it would stay good medium and long term. For the equity markets, I suspect central banks would flood the world with liquidity, more money. So actually they might hold up a bit better in the short term than you'd normally expect in a recession. And of course, interest rates will be coming down, which does help valuations. So we might do okay in the short term, but in the medium term, growth expectations are going to come down. So I think medium term returns will be somewhat lower, medium and longer term, but that'll be a problem for another day. So maybe in 12 to 18 months time, we'd have to think about that and take action to mitigate it. But in the short term, things will probably be all right. Standing here today, I can't tell you for certain which route the world's going to choose to cope with the emerging problem of inflation. Next month, I'm going to talk about the world if it chooses the option to prioritise growth to some extent and allows inflation to run a little bit higher. If you've enjoyed the video, please click on the flying colours icon to make sure you're automatically subscribed and hit the like button. As always, I must also remind you that I've been talking about investments and your capital is at risk.